Back in September, we did an episode outlining 5 common mistakes investors seem to make time and time again. Easily preventable pitfalls that could hamper your portfolio growth.
Because investment in general is not easy, and I do see people making similar mistakes that could be avoided.
That's Yuko Girard, portfolio manager on the multi-asset management team at Scotia Global Asset Management. She's back this episode with even more common investing mistakes.
Yeah, because I've been doing this for a while, and there's things that you just have to be aware of, and getting to know those mistakes and avoiding them is a smarter way to invest.
She'll cover everything from ETFs versus mutual funds, passive versus active management, even how psychology, things like loss aversion or FOMO, can hamper your investments.
Yeah, FOMO is fear of missing out. You know, you hear at the party or read on social media that people are making great returns and you feel like you want to get into that as well. I think this is where you have to be aware that just following on something that everybody's talking about is not the right way to invest.
I'm Stephen Maurice, and this is Perspectives. Yuko, welcome back to the show.
Thank you for having me.
So this is our second round of running through some common mistakes that investors make. We went through 5 last time, and you have another 5 for us to go through today, right?
Yeah, knowing these mistakes, you probably will have better success in getting to a portfolio that you are looking for.
Okay, great. Now, first common mistake, not fully understanding what it is that you're buying. And you hear quite a bit about, the difference between an ETF and a mutual fund, for example. And I think for a lot of people, that's still sort of a confusing thing. Do you want to talk a little bit about that?
Yeah, so it's interesting, like ETF is getting a lot of attention, but for us, ETFs and mutual funds, if you look inside those products, it's basically very similar. It's a fund. It's a collection of stocks and bonds or different investment. Mm-hmm. It's just the way it's packaged and how they're sold or bought is a little different. So ETF is exchange traded fund. So it is listed on the stock exchange. So mm-hmm. There's a buyer and a seller, and you know how much you're paying for that and how much you're selling it for that. And you can do it during the day. Like when the stock exchange is open, you can buy and sell it during that time. As opposed to mutual fund, you buy through the advisors. You don't really get the price until the end of the day. When the market closed, they calculate the fund price and they know, okay, I sold it at this price or I bought it at this price. But what's inside those are very similar. Now, people think ETF is cheaper because when the ETF came out, the first phase of ETF was a lot of, we call it a passive ETF.
Okay. And you mentioned that mutual funds are typically sold through an advisor. So I guess there may be an advice fee on there as well.
Correct.
And maybe you could explain the difference between active and passive management?
Yeah. So active means that there's a human being that is looking at different options or different investments and actively selecting or picking the right investment. And together, it will kind of give you a package of investments that will give you the best risk-adjusted return, we call it. So you're rewarded for the risk that you're taking, right, as opposed to passive is kind of like following usually an index. So indexes, we use it as a benchmark. Any stock market, you have like a S&P 500, you may have heard, S&P TSX for Canada. Passive means that you're trying to mimic that return or performance of that index. So there's not a lot of fund manager going in and selecting stocks. It's right, much more about just holding the same thing that the index holds and performing the same way as the index will perform. Mm-hmm. So therefore, it's cheap. And so people start to think ETF is always cheap, but only the passive ETFs are cheap. And we do have a mutual fund. It's also passive. So I think people have this misconception that ETF is cheaper and it's better, but really, it's more about whether it's a passive fund or active fund. So active means that there is a fund manager mm-hmm. who's selecting the investment inside that ETF or inside a mutual fund. So there's that human being analyzing and understanding what investment they should hold and what kind of risk they want to take. So there's much more work done in an active fund versus a passive. So when you're buying things, you have to be aware of whether it's a passive fund or active fund. ETF and mutual fund, it's just the way it's packaged and how it's sold is different.
Okay. This might be a very stupid question, but an ETF is traded on the stock market. So its value is determined by what people are willing to pay for it,
Right.
whether the entire thing is being sold or bought by
Right.
people. Where a mutual fund, like at the end of the day, its value is determined by the stocks that are within the mutual fund.
Yes. So you have to collect all the price that ended that day, and the collection of that will be the price of that mutual fund.
Okay. And active versus passive, that's sort of the key component, at least in terms of determining the fees that are associated with whatever it is that you're buying.
So one thing with the passive is that people think it's cheap and I just follow the index and therefore it's better. But people don't realize that having an index return is not always the best way, because if you see, like, let's say the Canadian market is S&P TSX composite index is the common index. And if you look at those index, or even like in the US, S&P 500, you don't realize how concentrated these index are. So if you look at the Canadian market like TSX, they really have a huge allocation to financials, energy, and materials. And all the other parts of the economy is much smaller weight. So just because you're buying that passive index doesn't mean that you're having the best risk-adjusted return. And a lot of the active manager, what they try to do is from there, select different stocks that can have a much better return or lower risk. So I just want to caution that just following the index return is not always the best way to invest. And it could be very concentrated and more volatile than actively managed funds.
Okay. So the first misstep, not fully understanding the product you're buying. In this case, we're talking about ETFs and mutual funds. People think they know what those things are, but don't necessarily understand that some are managed, some are not, some are active, some are passive, and all of that.
Correct.
Okay. Number 2, being impatient, or maybe trying to get rich quick. What are the risks associated with being impatient when it comes to investing?
I think initially when you start investing, sometimes they want to just get the highest return possible in a very short term. But when you have these investments that are having the high return, it doesn't continuously be highest return. There's ups and downs in the market. So something that's going up very quickly will go down very quickly. So you will actually have a much more volatile investment compared to, like, if you have a more diversified portfolio with different type of stocks, then they're gradually going up. You will have a much smoother ride to your target. So you have to be very patient. It's actually kind of boring. It's not like gambling where, you win or lose. It's almost like gradually and slowly but steadily you're going up a little by little. And that's the best way to achieve your goal. And then when we talk about investment, you always have to remember that compounding effect.
What does that mean?
So compounding means that you get a return on top of your return. So let's say you start with 100, you get 10%. Next year you have 110. Now you can return on top of 110, not 100. So there's a compounding, and that will kind of expand your portfolio, increase your return much faster. Keep it in the market, keep it invested, and that will get to your goal quicker than you think.
So it's about patience and discipline, not being too moved by the ups and downs of the daily market.
Correct.
All right. Misstep number 2, being impatient. Now move on to number 3. Common mistake number 3, letting your emotions drive your decision making. Can you talk a little bit about, I guess, the psychology of profit or the psychology of investing? And in particular, I think in your experience, people are more affected by their losses than they are by their gains. Can you explain that?
Yeah, we call it loss aversion. And what it really means is that the pain of losing is often far greater than the joy of earning the same amount. So a lot of time when people experience that loss, they're afraid to go back in and invest. They kind of keep remembering that loss and they just want to avoid that in the future.
Right. So the losses stick with you longer than the joy of a gain does.
Exactly. We call it loss aversion. Because, you start investing and maybe timing-wise you were unlucky and initially it started to go down. Once people go through that painful experience of you losing money, that experience is always in your mind and you're now afraid to invest. And then people are unwilling to take that risk anymore, even though you have to take risk in order to achieve that goal that you want to set. And investing is all about how much risk you want to take to get to your goal. So the common mistake is that sometimes people take too much risk. You try to get the highest return possible in a very short term. And then the other side is that you don't take enough risk, even though you can, because you have that time horizon that when you're retiring, you have a long time horizon. So you can go through the up and down. But just because you had the experience of losing, you just don't want to go through that emotion again. And you just don't want to take that risk.
Right. So it's about people overreacting, I suppose, to gains as well as losses and making decisions on that basis.
Yep. The other side is that when you start getting that good return, you don't know when to sell. And sometimes you get too greedy because you keep looking, maybe it's going to go up again. And at a certain point, you might want to say, like, if it went up enough, be disciplined, sell portion of it, and start investing in something a little cheaper so that you can continue to make that gain instead of hanging on to that one thing that's working, because at some point, it's not going to work.
But in your experience, you find people remember the losses more than they do the gains?
Yeah.
And that affects their decision-making more?
In general, even people are afraid to go into investment because they hear some people lost their money, so they just go into something like GIC or just stay in a savings account because there's no risk there. You know what you're going to get, but that return is always going to be, in the long term, lower than if you invest into the stock market or the bond market.
All right. So common mistake number 3 was letting your emotions dictate your decision-making, overreacting to short-term losses or gains.
Right.
Okay. We'll move on to number 4. I love this one, falling for the FOMO trap. What is that?
Yeah, FOMO is fear of missing out. You know, you hear at the party or you hear from friends or even like you read on social media that people are making these big returns or great returns and you feel like, oh, you want to get into that as well. And the problem is that people talk always about the good part and never about the bad part. Also, like if you do hear people made these gains, probably, most likely, it's a little too late to get into that thing. So you have to find your own opportunities instead of trying to follow somebody's stock tips. Like right now, we hear a lot about AI. Everybody's putting their money into this AI theme, and you feel like you want to get onto that as well. The trap is that when you hear people talking about it a lot, most likely that peak has passed. Right. And maybe there's a little bit more upside, but upside is limited compared to the downside. And I think this is where you have to be aware that just following on something that's working and everybody's talking about is not the right way to invest. We talked about diversification in the past episode, but I think you do always want to have different exposure to different investments.
Right. So that fear of missing out is seeing other people apparently making big gains on a certain stock and you feel like you need to jump into that, even though it could well be that the time to do that has already passed.
Yeah.
Okay. All right. Move on to our last one, common mistake number 5, overestimating your ability to invest on your own. So maybe underestimating how complicated it can actually be.
Yeah, so investing is not just about finding the right stocks or right companies to invest. That takes a lot of effort as well. You have to figure out each company, you have to look at their financial statements. You have to figure out what kind of management they have and what kind of debt they have, how much revenue they can grow, what kind of expense. So doing all that is one thing. And then you figure out what company to buy, what stock to buy. Now you have to figure out what price to buy. And then once you figure out you got in, now you have to monitor that all the time. So on a quarterly basis, they'll have some releases. Things are changing in the company. You have to follow that as well. And then you have to figure out, okay, if the stock, fortunately, can start going up and you start to get a good return. Do you want to hold on to it? Do you want to sell it for another stock? These are all constantly you have to keep doing to invest. Not an easy job. It takes a lot of time, and it's not something that you want to do on the side of your desk. It's something that you have to continue to do, and it's a lot of work for somebody to do it on your own. And right now there's social media, you get a lot of tips and, there's things that might be working or things that they're recommending. you really have to do your own due diligence on those as well. Like, why are they saying it? What's the source? What is the risk associated with this? Why are they recommending it? Because don't take somebody's tip and just follow that, because they're not going to tell you the bad part of it. They're just going to tell you the good part of it. You really have to do your own work. And I think because of that, I just find it takes a lot of time and effort, and still you could be wrong. And then you start doubting yourself and starting to change things that sometimes even make it worse.
Right.
So leaving it to professionals who have done it over and over and know the most efficient way to analyze these companies and figure out when to buy, when to sell. Those are all the things that probably it's easier to leave it to the professionals. Your job is really to understand what you want to achieve with that money that you're investing. You have to really explain, have a good relationship with your advisor and let them understand what kind of risk you're willing to take or you're comfortable taking. What do you want to achieve? And, maybe you have several goals. You have to explain the different goals you want to achieve in the short term and the long term. Building that relationship with advisor and finding the right advisors for you is where it can make a big difference. I think that can have much more success on achieving your goals than trying to find investment on your own and invest for different goals, because probably you're going to lose what your goal is to begin with when you're doing it on your own, because you get so overwhelmed with all the data and the information, and you're looking at your portfolio going up and down, and you lose sight of what you're trying to achieve. So I think it's much better if you can find that right advisor and explain what you want to do with your money.
Right. So it's kind of like we all know somebody who takes on a home renovation project, watches a few YouTube videos and thinks they can do it, and maybe gets in a little over their head.
Yeah, and sometimes you don't have the right tool, right? So you make mistake, and sometimes it's all about having the right data, right information, right tools, right way to think and judge and analyze. That all needs experience, and it's not something easy to do.
I guess all of these things start with having a plan, right?
Yeah.
It's about setting the goals, as you said, sort of from the outset.
Yep. I can't emphasize enough, you need to have a goal. And it's interesting because even a lot of people with a lot of money, sometimes they don't realize when you ask, they're like, oh, I never thought about it. So we always ask, before even what kind of investment you want to own, it's more about what do you want to achieve with your money?
Right.
People don't realize when you're investing to have that vision of what you want to achieve. So it's very important because, like I said, that kind of sets you be more disciplined and you can be more successful in achieving that goal.
All right, Yuko, we'll leave it there. Thank you so much for joining us again. Really appreciate you coming in.
Thank you very much.
I've been speaking with Yuko Girard, portfolio manager on the multi-asset management team at Scotia Global Asset Management. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time. This podcast has been prepared by the Bank of Nova Scotia and is provided for information purposes only. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments, including ETFs. Please read the prospectus before investing. The indicated rates of return are the historical annual compound total returns, including changes in unit values, and reinvestment of all distribution does not take into account sales, redemption, or option charges or income taxes payable by any security holder that would have reduced returns. Mutual funds and ETFs are not guaranteed. Their values change frequently, and past performance may not be repeated. Views expressed regarding a particular investment, economy, industry, or market sector should not be considered an indication of trading intent of any of the mutual funds managed by 1832 Asset Management LP. These views are not to be relied upon as investment advice, nor should they be considered a recommendation to buy or sell. These views are subject to change at any time based upon markets and other conditions, and we disclaim any responsibility to update such views. To the extent this audio contains information or data obtained from third-party sources, it is believed to be accurate and reliable as of the date of publication, but the Bank of Nova Scotia does not guarantee its accuracy or reliability. Nothing in this podcast is or should be relied upon as a promise or representation as to the future. The information provided is not intended to be investment advice. Investors should consult their own professional advisor for specific investment and/or tax advice tailored to their needs when planning to implement an investment strategy to ensure that individual circumstances are considered properly and action is taken based on the latest available information. Scotiabank includes the Bank of Nova Scotia and its subsidiaries and affiliates, including 1832 Asset Management LP and Scotia Securities Inc. Scotia Global Asset Management is a business name used by 1832 Asset Management LP, a limited partnership, the general partner of which is wholly owned by Scotiabank. Registered trademarks of the Bank of Nova Scotia used under license. Copyright 2024, the Bank of Nova Scotia, all rights reserved.